Hi, we can get started. Again, good day and welcome to this Risk Readiness webinar. I'm Ann Adams, Product Manager of Business Solutions for Risk Management Association. RMA is proud to make this presentation complimentary to members. If you're not a member, please explore all RMA has to offer at rmahq.org. Today's webinar is the latest installment of Credit Trends in Commercial Lending, Credit Risk Navigator presented by Tom Cronin at AFS. During the presentation, if you have any questions for Tom, please submit using the Q&A feature at the bottom of your Zoom screen, and we'll address it as many of your questions as we can at the end of the presentation. So at this time, I'd like to turn it over to Tom, and thank you for joining us today.
Thanks, Ann, and welcome to all the attendees today. This is our last webcast for the year for 2023, but we will be back in action on January 25th of 2024, if you want to mark that on your calendar. So we're taking a break for Christmas and the holidays. Today, we're going to look at the October 2023 data. So you're going to see a lot of year-to-date type looks. And without spoiling too much of it, you're going to see a lot of what we're calling cross signals, some positives and some negatives as banks seek safe haven or less risky assets. And we also have our latest or our last installment of the detailed review of the CRN dashboard. Today, we're going to be looking at the concentrations webpage. So let's jump right into that. And again, just a reminder, so all the data you're going to see is from the the RMA Credit Risk Navigator powered by AFS. And that's what we want to take a look at today. So let me go get that. So this is the concentrations webpage. Month before, we did the early warning, and then before that, we did the executive summary. So here's the concentrations. And we could have named this webpage Portfolio Management 101, as identifying concentrations in your portfolio is probably one of the most basic and critical responsibilities that you have. And if you think of the famous bank failures, having too much of one thing is a constant theme. And whether you go back to when I first started to Penn Square in Oklahoma and too much energy, oil and gas loans, or more recently to Silicon Valley and its over-reliance on technology firms, concentrations can be fatal, especially if the sector has above average risk. And we also know concentrations can be costly. Now, on a recent webcast, the people from S&P said that if your bank is overly concentrated in a sector with above average risk, they will downgrade your debt at least one notch, which equates to an increase, obviously an increase in interest expenses, depending upon how much debt you're issuing, and that could be quite substantial. So what banks do with this web page is attempt to see where they are an outlier. And are they being an outlier in a spot that's really where they didn't want to be? So here's an example. So right now, I'm on the industry tab. So again, similar to what you saw, there are several tiles. Here we have industry, geography, collateral, risk rating, and deal size. We're starting off on industry, and I've selected C&I. So we're looking at the C&I industries. And if this was your bank, if you're the demo bank, so the bank in blue, you could see that you have almost 17%, almost 18% of your assets, of your loans are in the F&I area. Very similar to your peers and very similar to your market. But you don't have to go much further. Matter of fact, go to one to the right to see that you have almost 13% of your assets here, 14% in healthcare, whereas the market and your peers are about half of that. And one of the things we're going to talk about later on in the presentation is some softness in the healthcare industry. So right off the bat, you would see that you have a concentration in an industry that is at least forecasted, if not already having problems. So this would be something you would want to address, and it's part of what our banks do when they address that. Let's move on to collateral, and we'll take a look at collateral, and we'll switch over to investor-owned real estate, and we'll look and see what we have here. So the first, again, starting on the left, you have over 50% of your commercial real estate loans. Again, this is a demo bank, but if you were that bank, you'd have over 50% of your assets your commercial real estate assets in multifamily properties. Again, we're going to see a little bit later on the NPL, their non-performing multi-properties are pretty good right now, but just on its face, having 50% of your assets in any one property type would seem to be a little bit high. Now, the whole real estate sector obviously is under stress, but still that much in one sector seems a little high, even though the rest of the market is not that far behind. And I just read today that I guess, I can't remember the name of the firm, downgraded 3 REITs that are basically multifamily with the understanding that there's so much supply on the market that they're thinking that the rent increases will not happen. And so the net operating income will start to decrease. So even though multifamily is doing well right now, seeing this much would give you cause for concern, and maybe you'd want to pull back. The last one I'll show you here is deal size. And again, you can look at any of these. Deal size. We'll stay with C&I. And here's a different look at the data and a different use of the data. As credit people, we're always thinking, where's my risk? Where's my problems? Here's an opportunity. And as you can see, this bank, again, if you're the blue bank, you have a lot of loans that are greater than 25 million, more so than the market. You have a lot of loans that are 10 to 25, but you've got basically nothing in parts and syndications. And this is a revenue opportunity. We actually showed this to one bank had something similar to this, not quite exactly this, but it was very similar. And they realized that they had a chance to syndicate these loans and participate these loans and, maybe scrape 1/8 of a point or 1/16 of a point, or get a fee, and turned it into a business that made some money for them. So 3 different looks here, 2 concentration, 1 opportunity, but that's how people use the concentrations tab. It really shows you where you are different from everybody else. Sometimes the difference is fine, and sometimes the difference is not, and it's something you want to take care of. All right. So that's the concentrations tab. Let me go back over to the regular presentation. I'll open it back up. All right. And we'll start with C&I as usual. A quick definition. When we say C&I, we mean business purpose loans. These are manually underwritten and risk rated. So exception managed loans are not part of this. And loans secured by owner occupied real estate are here in C&I. They are not CRE loans. Okay. And as we get started, we want to launch our first poll. And if you could launch the poll where we're talking about shedding assets.
Sure, just 1 second. Oh, sorry, they look to be
That's
out of
right.
order. They look to be out of order. I don't know why. Something changed with Zoom just to keep me on my toes. Here you go. Tom, are you seeing it launched?
No, still seeing question 3.
Okay, so let me end that and then get to this. Yeah, that looked.
It wouldn't be a Commercial Trends webcast without some technical
Yeah,
problems.
I know. I'm happy to participate there. Okay.
There we go. Okay. So this question is, what we've seen and read a lot in the last, say, 6 to 12 months, you have many banks are shedding riskier assets. And so the question we have for you, and here, this is just a single answer, single choice. Is your bank identifying and dropping riskier borrowers or planning to? On the other hand, have you increased your portfolio, seeing that this is an opportunity to lend to some companies that normally wouldn't? Or are you just not making any changes? Is it business as usual and you're trying to handle riskier assets as you normally would with your regular credit policy. So we'll just wait a second and see what the results are here.
Okay, looks like most of the responses have been entered.
Okay. So 47, 13, and 40. All right. Okay, thank you for that. As I've mentioned before, I usually think I know what the answers are going to be ahead of time. This is one that I had no idea what to expect. So I think that's interesting that half of you are basically, taking a look and de-risking the portfolio. Okay, so let's get started with our performance data. So we're going to end 2023, or at least our portion of 2023, kind of with a bang. As you see here, and you'll see a little bit more on the next slide, which I've cut down to just the last 10 months. Non-performing and short-term delinquencies has spiked in the last couple of months, and non-performing is closing in on 1%, something we haven't seen since the COVID closure impacts. So everything that we had recovered, again, I'm looking at the dark blue line for non-performing, and we're back down close to 0.5%. Things that, levels we hadn't seen since 07, 08. We've lost that all in the last couple of months. Short-term past dues are well above 0.5% now. And I've talked quite a bit about not overreacting to a month-to-month change for delinquencies. But again, as you'll see on the next slide, as a matter of fact, let me go to that now. If you go back to February and look at short-term past dues in the gold, you can see the overall trajectory is up. So the change here that we're seeing over just the last few months is not good. And this is an example of the cross signals that I was talking about. I just happened to look at the journal this morning and saw that Dow, I guess it was 32,000 about a month ago. It's now 35,000. So you're seeing increases in the Dow and the S&P, decreases in the CPI, but yet we're seeing loan performance data start to suffer, and suffer at a good level, at a high enough level that would give me some concern. So let's take a look at some specific industries in terms of what's happening. So when I first looked at this, I said, what sectors are worse off? And then the blue is December 22, the gold is October 23. And then I changed the question to, or thought the question maybe should be, which sectors are not worse off? And what I found is on the positive side, 11 agriculture is better and 55 management is better, and a little bit 56 admin and support. Everybody else is worse off. And we're seeing levels in October that are approaching 3 times what they were at the beginning of the year. And that is specifically for industries, 32 manufacturing, 45 retail, 48 transportation, which you see right there in the middle, probably stick out more than anything else, 51 information, and then 53 real estate, which has rental and leasing in it as well. And on the next 2 slides, we're going to take a deeper look at a couple of these. But when I'm thinking about this, what I'm trying to decide is, are these cautionary flags that we're seeing, or are these red flags? I'm not sure if we'll really know for another month or two, but at a minimum, I think the fact that just about everybody is up is a cautionary flag as to what's going on in the marketplace. So let's go look at a couple industries here and see really what's driving this. And in Credit Risk Navigator, we can drill down to the 6th digit of the NAICS code. Here we're looking at the 3rd digit level for 48 transportation. And let me flip back for a second. You remember 48 transportation went from 0.5 to almost 3.5. So quite a huge jump. Within 48, the highest subsectors are air and truck transportation. And within air, the trouble is for chartered flights. The trucking is, I'm not saying we had yellow truck in here, but I think the problems the trucking industry is having, as evidenced by the bankruptcy of Yellow Truck, gives you some idea of what's happening here. And then the water that you see basically came from nowhere and now is close to 4%. That's for cruise lines. And we'll talk about this a little bit more on the next slide as well. So here's the same 3-digit NAICS analysis for retail. And you'll notice on the left, the first one on the left, 451/9 sporting goods. I've combined those because 451 and 459 are the same, just different numbers. And there's two subsectors, again, very easily, two subsectors that you see. The sporting goods is also hobby stores and bookstores. They're now non-performing is up above 6%, but the non-store retailers are double that, and that's electronic retailers. And some of that is we've talked in the past a little bit about the e-commerce, not Amazon, obviously, but some of the others having problems. And if you think about these two sectors, the 45 and the 48 that we just showed you, and what's going on, really, with the exception of trucking, all of these subsectors are, I think, what you'd call consumer discretionary. And as was predicted, these are negatively impacted by high inflation and lately high interest rates. And what we were reading in the Wall Street Journal is that consumers are giving priority to necessities, such as food and drugs, over discretionary or luxury purchases, such as cruises or chartered airlines. So you're beginning to see the high inflation and high interest rates have an impact on consumer, specifically consumer discretionary industries. Now, we sort of knew this was coming. Nobody was really sure when, but now we're starting to see it. So let's take a look real quick at non-performing by geography. And I should have mentioned, sorry, I apologize. When I say non-performing, I mean 90 plus days past due plus non-accruals. All right. And as another reminder, when we say geography for C&I, it's based on the location of the borrower, not the bank. So if a loan to FedEx would show up here as being in Tennessee. And technically, 6 of the 7 regions are worse off now versus the beginning of the year. But realistically, 3 are flat, and the other 4 have substantially elevated non-performing levels. The region with the highest percent of non-performing loans is the Western Midwest that you see there on the far right. And within the Western Midwest, we're seeing problems in a number of states and sectors. But the biggest increases in non-performing was in the state of Missouri for air, water, and truck transportation, which we just talked about. And we're also seeing big increases in Kansas, also for air transportation. Within the Eastern Midwest, coming back over to the left side, the second highest now, we're seeing problems in Illinois for consumer goods rental, and also in Ohio for commercial machinery rental. And here we go again, air and truck transportation. So seeing some of the same problems throughout the country. All right, so that's the performance. So before we go on to credit quality, we have our second poll that we'd like to launch.
Okay.
All right. So as we near the end of 2023, what we'd like to know is what's your bank's outlook for 2024 in terms of credit quality? And there are 5 choices here. So the first is you're not expecting any change in credit quality. You think it's going to be the same. The second, you would expect a modest increase in credit quality. And when I say increase here, I mean that your credit quality would get better. So if your loans are usually rated a 5, they'd now be rated a 4. So from average to above average. And modest would be just, a little bit. Significant increase in credit quality is the next one. And so that would be, you expect a really big jump in credit quality. And then on the opposite of these, a modest decrease in credit quality, so your loans would get a little bit worse, or a significant decrease in credit quality, which would be your loans would get substantially worse. And we'll just wait a second to see what people think. Pardon me.
Okay, it looks like most of the responses are submitted.
All right.
Oh, I had a couple more come in. I'll give it a second. Looks like some people were thinking about this one.
All right. So 22 the same. 4 and 0. 76 minus 8. Okay. So this, I again, I say always guess. I thought modest would be the highest, but I did not expect it to be that high. I'm really surprised at that. So let's take a look at the risk ratings now and credit quality. And just a reminder, when a bank joins Credit Risk Navigator, we map their native borrower risk ratings into the RMA 10-point scale. And on that scale, borrowers rated 1 through 6 are pass credits, 7 is special mention, 8 is substandard, 9 is doubtful, and 10 is a loss. So here we have the weighted average risk rating trend from the start of the service in 3Q03 to October of 2023. And you can see the increase just prior to the recession, beginning in early 2027, and then the March increase 2020 for COVID. And then as COVID measures ease, similar to what we just saw with the non-performing chart, we saw a drop in the weighted average risk rating. It actually dropped to 4.37 by January of this year, but now it's gone back up to 4.6%. Once again, not quite, but almost totally erasing everything that we had gained post-COVID. So let's take a deeper look at some of this. Here's just the last couple of months, and you can see that the increase really started in the March, April timeframe and has really ramped up lately. Leveled off a little bit in the last 2 months, but much more. I think people are much more pessimistic. And given your answers on the poll question, I think that mirrors this exactly as to what we're seeing. So here I've created a split, 4 splits of the 10-point scale. High is 1, 2, and 3. Moderate is 4 and 5. Low pass is 6, and then criticize is 7, 8, 9, and 10. The gold is October, the blue is December, and you can see a definite shift from the left to the right, from the better rated borrowers to those with poor credit quality, namely the low pass and the criticized. And we're going to talk a little bit more about this. We're also going to see this with CRE, and I think when you get a chance, if you can contrast this with CRE, you'll see a little difference as well. So because we're seeing an increase here in the low pass and criticized, I wanted to talk about what I call distressed loans. And if you've not been with us before, let me take 10 seconds to explain what I mean. So regulators traditionally will look at loans to borrowers tagged as criticized, which is special mention and above. But in an analysis we did during the CCAR stress testing period, we found that a large percentage of 6s or low passes migrated to criticize. So here we've added the 6s to the criticized, and we call this new calculated category distressed loans. And you can see from what we were just talking about, almost 25% of the portfolio is distressed. And you can see that some of the individual sectors are well above that. And once again, it's easier to say what hasn't increased over the past 10 months. Only 2 industries have improved in terms of being distressed or their distress levels. Those are 23 construction, and then way over on the right-hand side, 92 public admin. Every other industry sector saw an increase in its distress levels, and all but 2 sectors are above 15%, and 18 of the 24, 25, I think it is, have distress levels of 20% or above. And then some are really high. 31 manufacturing is now at 45%. And we have some others that are above 35%, namely agriculture, 45 retail, which we discussed with the non-performing loans earlier, 62 healthcare, which I referenced during the concentrations demo, and 72 accommodations and food, which is both hotels and restaurants. All of those are above 35%. All right. So we wanted to finish up the C&I portion with a look at the weighted average risk rating by collateral. If you were with us, I think it was 2 webcasts ago, we asked what's important to you when you're rating your customers. And one of the items that you said you looked at was collateral. So we thought, let's take a look and see what we're seeing for collateral here. And again, I don't want to be a broken record, but there's only one collateral type that saw an improvement in its weighted average risk rating, and that's deposits. Every other collateral type has a weighted average risk rating for October that is above what it had for December of 2022. And more than half of these now are above 5. And with 5 being the average pass, whereas before they're all in the 4 range. Farmland, agriculture, there in the middle has the highest weighted average risk rating. Unsecured has the best, which you sort of expect because most banks only make unsecured loans to their best customers. So over the next few months, we're going to expand this analysis a little bit in looking at collateral. We have a couple other measures we can look at. But if you have any thoughts or ideas on what you'd like to see regarding collateral, please let me know. Either send me an email, which you'll see my email and Ann's email later on in the presentation, or participate in the survey at the end. Let me know what you think. All right. So now we're going to move into CRE. And when we define CRE, we're following the interagency guidance, which basically says if more than 50% of the repayment comes from the sale or rental of the property, this is CRE. You'll also hear these facilities referred to as investor owned as opposed to owner occupied. So this is investor owned. All right. So before we get started, we have our last poll. So everybody had a preview of this early on.
Yes,
So
yes. We had some time to think about it.
Right. And this one has a little bit of a few options to it. So the senior lending survey just came out or recently came out, and there was a lot of talk about tightening lending standards. So what we wanted to know, pardon me, is have you tightened any of your lending standards for any of the following property types? And there's the big 6 or 7 here. So office, industrial, etc. I've also included a category here for all CRE. It's very possible that some banks have just said, we're going to tighten up on all CRE. And then I did leave one in here for no tightening at all. Again, very possible that banks are viewing this current market as an opportunity to make some headway. So we'll take a few seconds here to see what people are thinking. And again, you can choose more than one here.
Okay, it's looking like the responses are coming through. Maybe 1 or 2 more might be. Okay, I will share.
All right. 40.
Let's scroll this a little bit so you can see better.
Retail is 16, healthcare is 16, 10. So all is 39. So oh, so we do have, did anybody say no tightening? 10%.
Yeah.
Okay. All right. Okay. Very interesting. I appreciate that. Obviously we can't do this here, but this would be something I'd like to, if we could in another method or somehow have a Q&A and talk about why people are doing certain things, what they're looking at. And I think as we go through the next set of slides, you might be surprised on some of the things that you're seeing. All right. So let me move on to performance. And this is these charts, first two charts going to be the same as you saw for C&I. This is the non-performing short-term and medium-term delinquencies. Again, non-performing are loans that are 90 plus days past due, as well as non-accruals. And lately, these are basically showing the same results, pardon me, as C&I with one exception. So if we recap, the CRE performance reacted to COVID closures a little slower than what we saw with C&I. So you can see it really didn't get up there until the early 2021, but began to recover in early 2022, but never got back to pre-COVID levels, unlike what we saw with C&I. And then towards the latter part of last year, the non-performing levels started to rise. And now we've jumped to 1.2%. And let me move on to show you here. 1.2% from 0.99 in just 2 months. And once again, delinquencies have fluctuated quite a bit over the life of the service. And I don't like to put too much emphasis on a month-to-month change in delinquencies, but you can see, both of these, the gold and the green, are tailing or heading in the wrong direction. I would expect these might come down again, but I think the level will come down won't quite be as severe, or the general pattern. What I'm trying to say, I think the general pattern will be continue to rise, because I think there's a couple different things happening here. So let's take a look at some specifics. So here we have non-performing levels for the 8 major property types. And those 8 major property types are based on outstandings. And there are 2 very obvious movements. Lodging has been improving significantly. It's gone from 5 to just a little bit above 2%. As people have started traveling again, businesses are traveling, a lot of improvement in the lodging industry. Offices, on the flip hand, no surprise, have been getting worse. And just, it's in the paper every day. I don't think there's anything new I could say about that. For the 5 others, conditions have worsened, but at differing degrees. For example, the non-performance loan for residential has almost tripled, but it was kind of low to begin with. For healthcare, it's gone up about 10%, but is now above 3%. So you have, a couple of different factors going on here, things getting worse, but only off a very small base. But I think what's important to recognize here is that the problems in CRE are not limited really to the most publicized, which is office. Outside of industrial and lodging, we're seeing elevated levels for all property types. And I thought it was interesting on the reply to the poll that about 39% of you, 40%, have basically said we're tightening standards for all CRE. And without being, trying to tell you what to do, I think that's very prudent. It's just, you get the sense here that things are heading in the wrong direction for everything. Here we're looking at geography, non-performing geography. And again, geography, or different from C&I, geography is location of the property, not the borrower. And as we saw with property types, we have a little bit of mixed bag, performance by location. In the middle, we're seeing improvement in the Northeast because the improvements in lodging in the Northeast, particularly Boston and New York, are outpacing the deterioration in offices and a little bit of a deterioration for retail and multifamily. So the lodging improvements are making the Northeast look good. If you stripped out lodging, Northeast would look bad. Conversely, the decline in the South is related to substantial declines for offices and slight declines for health and retail. And when you look at specific states, pardon me, we're seeing office non-performing loans for the increasing in Florida and Georgia. And the office decline, not specifically talking about Florida and Georgia, is actually throughout the US. Every region's non-performing loans for offices is up. And the largest states that are having problems with offices are New York, California, Texas, Massachusetts, and Georgia. That's where we're seeing the largest non-performing loans for offices. So on this page, we have the weighted average risk rating trend starting in 2010, which is when we first began tracking CRE borrowers separately. And on the next page, I have the more recent numbers. But from this chart, you can see that the weighted average risk rating for CRE had reached a service low right before COVID, right there in the 2019, 2020 time. But there's been considerable movement since then. And I think it's actually easier to see on this next page what's happening. I think the more recent trend gives you a better idea. And again, when you got time, take this and compare it to the same performance chart or the weighted average risk rating chart that we just saw, the same performance chart. And usually we find ratings as being reactive. But here you can clearly see the increase in the weighted average risk rating started at the beginning of the year, which was foretelling the increases in delinquencies and non-performing loans that we have recently experienced. And as we said, the CRE member banks have been anticipating this drop in performance for some time, and many member banks have been preparing for that drop by de-risking. And that's one of the benefits of belonging to the credit risk navigators. You can see what other banks are thinking, and particularly, the overall portfolio like CRE, and then specific lines of business or specific property types, and make your changes as you need it. Here's the risk rating mix. As we did for C&I, bucketed the RMA 10-point scale into 4 categories. There's a pronounced shift again from the left to the worst ratings, and over 1/3 of CRE loans are now classified as low pass or criticized. And on the next page, we're going to look at this group a little bit closer by property type. So again, 1/3 are low pass or criticized. So that's what I call distressed. And we group these so you get a better sense of what loans and property types are at severe risk. And the trend is very similar to what we saw in the non-performing chart. Lodging has improved. So now both performance and credit quality. Office has changed the most, going from 31 to 56%. So over half of your office loans are low pass or worse. Industrial property, so a couple surprises. Industrial properties saw a surge in distress, and they've gone from one of the best to now one of the worst at 43%. What we're hearing on this, because that's sort of, I guess, would be surprise to everybody. And matter of fact, I think 2% said you're not tightening lending, you're only tightening lending standards for them. What we're hearing is that there's an overbuilding of warehouses, and that the e-commerce phenomenon that we saw with COVID is easing a little bit. And now you have a lot of spec warehouses that are not being leased out. And then one last thing they'll mention, in terms of distress, multifamily has more than doubled. Again, if you remember, the first thing I showed you today was the concentrations webpage, and we saw a demo bank that had over 50% of their loans in multifamily. And I said, even though the non-performing loans for multifamily non-performing level was good, you can see here that the distressed, or the outlook, if you would, for that is not good, as there's supply pressure on multifamily apartments. And as a matter of fact, in the article I was reading, it said that in the third quarter of 2023, construction of multifamily properties was at its highest since the 1980s. So, again, as I'd mentioned, there seem to be a lot of cross signals. We're seeing some good things, but with the performance numbers going up and with the credit quality numbers looking sketchy, I think now's the time that banks should just really be taking a look at what they're doing and where they want to be, and how they want to go forward with portfolio management. All right. So, Ann, that concludes what I had to say today, and I'll turn it back over to you for any questions.
Great, thank you. We do have one question that I'll read, and also if there's any other questions, feel free to use the Q&A box at the bottom. But the question is the deterioration in C&I primarily in one or two banks, or is it widespread among multiple consortium participants?
It's widespread, and I don't have the exact figures, but I think one of the things that when you get the deck, if you look, you can see the non-performing loans by geography, and you can see it's across every geographic sector. There are a couple of industries that are getting hit harder than others, notably those things that are what we call consumer discretionary oriented. But in terms of, it just seems like almost every bank in the service, there might be one or two that are not increasing in non-performing, but just about everybody is seeing increases in non-performing loans.
How much does the increase in rates contribute to the distressed loans?
That's a good question, and frankly, I don't know. When we were doing the CCAR analysis, we actually were getting financial statements, and we were able to see things like interest expense, so we could gather that. So I don't know specifically. All I've known is, all I have is anecdotal information. And I think the one I mentioned 2 or 3 webcasts ago is one of the pet companies had like $1 billion or $1.9 trillion in debt, and their interest rate went from 3.5% to 9%, and basically destroyed their cash flow. So I think I have anecdotal, information like that, but in terms of exact information, I don't have that. I think the combination of inflation and interest rates is causing a lot of these problems, but again, I apologize. I don't know exact number.
Great, thank you. I'm not seeing any other questions at this point. Tom and I can stay on for a little longer in case someone's still typing. But in the meantime, thank you, Tom, for sharing. And thank you to everyone else for joining. We do look forward to having you at our next session. And so for now, this will conclude. Oh, we got one more. Most of the reasons for distress is the CRE loans that have matured this year or next year due to the rate differences from origination. Have you looked at maturity walls?
We have, and I don't mean to be, and I hope you don't take this as me being too cute. That's something we have looked at maturity, and that's something that we reserve and show only to the CRN members. That there are a couple things that we reserve for CRN members. Maturities, loan growth is another one. So that's something we've done. And if you join, I can tell you. Otherwise, I cannot.
Yeah, very fair point, and does open that up to say, Tom and I are obviously always open to talk to anybody who is interested in learning more about the Navigator product and what that would entail for sure.
Right.
Awesome. Well, thank you again, and this will conclude the webinar. Please take a moment at the end of the event to complete your survey, and thank you, and have a great day.
Thank you.